Good morning, everybody. Happy to be here. My name is Kloks. I'm from the University of St. Gallen, Switzerland. I think an important topic, swap lines, right before lunch. It's an empirical paper that's going to use a novel data source, right? I'm going to use settlement data to try to uncover how swap lines really work. And what I mean by that is whether swap lines affect the demand and supply for the dollar in financial markets, right, such as the FX swap market. Motivation, of course, it's again, super important topic because there's a massive demand for the dollar outside of the US, right? Think of typical example of a Japanese life insurer, right, making investments in the U.S., corporates, smaller banks. So central banks around the world really care about dollar access, and they want to understand how swap lines help in this regard, and especially, of course, try to understand what might happen in financial markets for the dollar if swap lines were to be scaled back. One way to think about swap lines is that swap lines provide access to the Fed, right? Swap lines provide access to the Fed. What I mean by that is if you're a bank outside of the US, right, think of a small German bank, you don't have an account at the Fed, the way swap lines work, and I show that graphically in the next slide, is that through the local central bank, you can actually borrow dollars from the Fed directly. Swap line is actually a very important dollar liquidity facility for the Fed. If you look at the size, right, it peaked at around $500 billion during COVID. Having said that, I think the reason why I'm here is that there's really very few empirical studies on this topic, right? Why is that the case? Because there's just this massive data gap there, right? You're really now looking at research on FX, which doesn't have a good data source, right? Because it's traded in different venues by different market participants. So this is where kind of this novel data source is going to come at play. A bit more of a background so everybody's on the same page. What's a swap line? Well, effectively, you can think of a swap line of being effectively an FX swap contract with the central bank, right? Maybe we can look at the figure here. If you're a German bank, and you need dollars, right? If you're a German bank in Germany, you cannot go directly to the Fed. One option that you can do is just tap the dollar auctions at your local central bank, specifically the ECB. And because the swap line works in the sense that you can start with your domestic currency, euros, to obtain the dollar for a period of time, such as a 1 week or a 3 month. This matches exactly the cash flows of an FX swap, right? So there's the swap line and an FX swap contract are close substitutes. So I think there's a natural question, do we observe any co-movement between borrowing from a swap line and how banks trade in the FX swap market, right? Why would a bank like Deutsche Bank ever borrow from a swap line? It's actually not a trivial question to ask, especially because swap lines come at a penalty rate. I think a few important reasons why this happens. One is that going to the FX swap market also costs costs in terms of that there's a premium for dollar borrowing, a non-negligible premium. This is what's known as the cross-currency basis, right? A few other reasons are that swap lines, if you go to the ECB, they're full allotment, right? Which means you don't run into into any concentration limits. You don't have price impact. Other alternative to FX swap market would be perhaps the repo market. Here in the swap lines, you don't need collateral. You can start with your domestic currency, right? Which in times of crisis might be important. So swap line is important backstop when the FX swap market is impaired. How should we think about the FX swap market? Is it an important market? So obviously, I'm going to say yes, right? But I think just looking at this figure is pretty informative, because if you look at trading volumes from the BIS, how much is traded in FX swaps, that's the yellow bars, relative to other FX instruments, such as even FX spot, right? That's the red bars. And what you see is that there's actually more trading in FX swaps than in spot. Why is that the case? Well, I think ultimately it comes back to the huge demand for dollar assets outside of the US, right? So if I'm a life insurer who wants to invest in the US, if I enter a spot, let's say I start with euros, right? I cannot buy a US asset with euros. If I enter into a spot contract, I'm going to obtain the dollar, but there's going to be an FX risk involved, right? The way to hedge that FX risk is to enter into an FX swap, right? It's going to give me the same exchange of notionals at the near leg as the spot, but I'm also going to fix the exchange rate at the far leg. This is why FX swap market is so important. So I think if you're an empirical economist, right, and you want to study swap lines, why wouldn't you just look at data from the BIS? The main reason is that it's just not granular enough, right? This particular data source is released only once every 3 years, right? So you cannot really apply this kind of BIS data to study swap lines that at higher frequency. And more broadly, I think there's clearly a very, very large data gap in this segment. Why? Because any other data source that is used to study this market is, for example, central bank trade depository data, right? You might use, for example, Bank of England data, other central bank data. It's more granular, right? That's great, but it's not as representative of the global volume dynamics, right? So there's clearly a need for a representative data that's still granular enough to study swap lines. And what I use in this particular paper is settlement data from CLS. The intuition is that even though FX swaps are traded in a very fragmented manner, they're settled through one firm, basically CLS. This is a firm that these market participants know very well. So we basically called up this settlement firm and said, hey, could you give us data on the FX swap market? You could also think of this data as just being like a payments data, right? So it's from a third third party, combines trading from different jurisdictions, different trading venues. So what do we observe when we look at this data? So obviously we're going to study how these foreign banks demand dollar in the FX market. But I think equally important is to think about who is supplying those dollars, right? And if what's interesting is that we find that even though if you look at the second bar here in this graph, U.S., right? If you think about the residence versus the nationality principle, most of FX swap trading happens outside of the U.S., right? That those are the gray bars. This is why I think the Fed might have a challenge of accessing data on this market. A lot of it is booked outside of the U.S., but it's still a market where U.S. banks dominate, right? More than a half of trading volumes go through U.S. banks. So I think conceptually, the way I think about this market in this paper is that I have U.S. banks kind of as dealers, right? I think of U.S. banks as market makers who are providing dollar liquidity, and I'm going to think of foreigners as kind of price takers, right? And the question that I ask basically is, if swap lines are available, do foreigners demand dollar less in the FX market on a net basis? And if yes, is this in any case kind of reflected in prices, right, that U.S. banks charge? Let me summarize kind of the main findings of the paper here. I find that U.S. bank price setting is actually sensitive to how much dollar is demanded from their customers, right? Specifically, I see that U.S. banks charge wider bid-ask spreads when the trading volume is more imbalanced. What I mean by that is I calculate the net exposure that U.S. banks have. This is defined as just the amount that U.S. banks lend minus how much they borrow. So this number is positive, meaning that U.S. banks are net lenders in the FX swap market, right? In the magnitudes of $2 to $300 billion. But what I show is that when there is more demand from customers for dollar borrowing than lending, when demand is particularly imbalanced, U.S. banks charge higher spreads. One standard deviation increase in this net borrowing is associated with an increase in effective spreads by about 0.7 basis points. I use kind of an instrumental variable setup to try to disentangle these forces, and let's see how much I can go into that here today. And then the second finding is, okay, how do swap lines enter this discussion? And the finding that I document is that when swap lines are available, U.S. banks actually see less dollar demand on a net basis from customers, right? On average, the effects are actually quite moderate if I look at the past 10 years of data, right? But they're more substantial in stress episodes, especially in COVID times. And then I think what's really an important contribution in the second part of the paper is to ask, net dollar borrowing that's, reflects both the lending minus the borrowing, right? We expect when swap lines are available that what would be particularly affected is customer demand, right? Intuitively, customers might substitute away from the FX market, not borrow in FX market anymore, borrow through swap lines. This has been, there's been evidence of this in the prior literature, but we don't really have evidence that customer dollar lending might be affected in the literature. And this is what I found in the second part of the paper. It's also dollar lending that's affected, and then I talk about, is this because foreigners are doing more arbitrage with these swap lines, or is there other reasons for it? Let me skip the literature. Let me say 2 sentences of why U.S. banks would actually care about customer demand. It's not obvious, actually, because FX swaps are derivatives, so they're off balance sheet, so they don't actually count much for the leverage ratio. The point here is that if U.S. banks are not running a perfectly matched book, but they are lending more than they're borrowing, any net imbalance has to be funded somewhere, right? The reason is that in an FX swap, notionals are exchanged at the near leg. So in the first part of this paper, I'm basically asking, do U.S. banks charge wider bid-ask spreads in response to more imbalanced customer volume? But particularly because I expect that it's more costly for U.S. banks to store this on-balance sheet inventory when their balance sheet constraints bind. I expect kind of this effect to be stronger in bad times, right? I measure transaction costs from settlement data. I think importantly, these are not the quoted bid-ask spreads that U.S. banks charged. I don't have data on that. What I do here is I proxy the effective spreads from realized transactions measured as simply as the spread between the contracts where U.S. banks sell the dollar versus where they receive the dollar. I express that in a CIP deviation just to control for the level of interest rates. A document in the paper, a bit more information on these spreads, because I'm the first really to analyze effective spreads in this market. I find that the effective spread is a bit smaller than what's the average Bloomberg spread. And then now, I think to cement a little bit more this finding that U.S. banks would actually care about the customer order flow, I use an instrumental variables approach. The reason for it that obviously prices and quantities are endogenous to one another, so you're looking for some kind of a shock. I think an interesting exercise is to think about if swap lines themselves could be used as a demand shock. Obviously, it's not easy to use swap lines because the use of swap lines, how much banks borrow swap lines, is endogenous to the pricing in the FX swap market. But I think one interesting exercise is to think about the availability of swap lines as an instrument. The idea here is that, if you go back to the second slide, a German bank tapping the dollar auctions of ECB, those auctions are generally over the past 10 years not available every day. Right? They're only available on certain once a week, so we can compare how banks behave on dates of auctions relative to days of no auctions. And we can, this is what this is the setup I have in mind here. And specifically, when we think about the dates when swapline auctions are available, I'm going to think about foreign bank demand in FX swap contracts that I expect to be affected by swap lines relative to those that are not. The intuition is that, so basically, I'm trying to use a little bit of the operational details of the swap line setup, right? Swap lines are only available up to 3 months maturity, right? So, but the FX swap market is liquid up to 1 year, so that's kind of one source of variation. The other is that to access the swap line auction, you need to be a depository institution, so non-banks cannot do that. I have the first and second stage results here. I think the first stage maybe is even more interesting. I do find that on days when swap line auctions are available, foreigners demand less dollar from US banks. That's the first two columns there. And this is not really observed if I look at the part of the market that I expect to be less affected, such as non-bank demand, right? Non-banks cannot access swap lines directly, or non-foreign bank demand in these 1 year longer-term tenors. And then I establish as well that the instrumented flow is affected, is linked to the spreads. Additional results I'll skip here. The additional results basically look at whether the relationship between the net flow and the spread is stronger when U.S. banks' balance sheets are constrained, or when reserve balances reserves are more scarce. Right. Let me now turn to the second part of the paper. This is something different what I do now. Here, I'm interested in decomposing this net volume into dollar purchases versus dollar sales, right? If you, I already mentioned that the net dollar demand could affect both of them, right? If you think about demand substitution, then you would expect foreigners to reduce how much dollar borrowing they do from U.S. banks, right? This is kind of the intuitive finding that you would expect. Dollar sales, not really talked about in the literature, only perhaps in the context of swap line arbitrage, right? I look at the decomposition of the net into dollar purchases and sales around the COVID-19 episode. So I think here the main challenge is that the researcher knows when swap lines are tapped, but not really who uses them. I think one interesting case to study is the Bank of Japan during COVID. Why? Because this was where really dollar shortages peaked. This is the largest swap line take-up during COVID. It was by Bank of Japan. Actually, if you look at the shares here, Bank of Japan was over 50%. And what's useful is that we know from kind of what Bank of Japan has reported that this was driven by domestically Japanese banks, right? And if we look here on column 5 and 6, I'm again thinking about the diff and diff, comparing short-term versus longer-term contracts when these Bank of Japan swap lines are tapped. We expected a negative coefficient on column 6 on the diff and diff, right? This is what I confirm. It kind of indicates that there is some evidence for substitution. But I think what's very interesting is that economically, even larger effect, which you see is in column 5 on dollar sales. So these domestic banks not only reduce their dollar purchases, they appear to also have lent out the dollar exactly when they borrowed from swap lines. So this is a counterintuitive kind of mechanism. This is something that I discuss in the second part of the paper, why this could be the case. I think what I conclude is that there's not much evidence that this was arbitrage activity by Japanese banks. I think there's more evidence that Japanese banks borrowed swap line liquidity too much. They had a surplus of the dollars, and because you cannot deposit dollars at the Bank of Japan, there's more evidence for kind of a hoarding of liquidity that these domestic banks appear to have parked some of that liquidity in the FX swap market. I think it's still important to think also about these dollar supply effects, because if you think back to intermediaries, right, this is a crisis time when U.S. dealers face a lot of dollar demand. If we see evidence that foreign banks are also kind of more willing to lend during this period, it's one important channel that kind of puts downward pressure on the dollar borrowing in FX during the crisis times. Thank you. Let me conclude here.
We have Lena Lu from the Boston Fed to discuss the paper.